Good morning, Jags. This is Fahad. Today is Wednesday, October 21st. Let's get started. The chart that you have in front of you is VRM, symbol VRM. Now, this is the online e-commerce company for the auto sales, and this stock is settled back in quite a bit from 75, high of 75 to currently $49 and change. And it has been building a base for the past month or so. Some of you may remember in the chat room last week, I pointed out that they were buying what they call call tree, essentially positioning themselves for the next earnings, but doing so with the structure that's called call tree, which is a variation of a call spread. Nevertheless, it's a bullish bet. I wanted to bring this up because I continue to look for a potential technical breakout in this name, and I want to see if this thing will start to clear about 52 to sorry 52 to $53 per share. And if it does, then it will signify that we have a breakout, technical breakout through the basing formation that could carry the stock higher all the way up to 60 at least as the first target. There's going to be some minor VOP resistance there. If we clear that, then we're going all the way to $65 per share. So there could be plenty of room to gain to make money on call options or just common stock as it starts to break out. The company will report earnings sometimes around November 12th. The date is not confirmed yet, but here's a couple things on the fundamental side that I'd like to point out. Um, I did some reading on the industry to see how much the penetration for the auto sales in the e-commerce space has already happened in the United States, and if we reached a point where it's starting to become significant, and I'm quite surprised still how fragmented this market remains and how low it is. Carvana, as you know, is also the biggest player in this particular space. Right now, according to JP Morgan note, they point out that the total market penetration is less than 1% currently. Less than 1% of all autos are sold online. And if you look at the physical car dealer space, that is so fragmented with literally hundreds and thousands of players and shops all around the country with nobody actually having any kind of commanding lead in any way. They do expect that the total market penetration will double for the online players, going from less than 1% to about 1.7% by the end of 2021. And what's going to push this higher is Carvana is likely to do with total volumes growing by 61% year over year next year in 2021, and Vroom posting volume growth of 101% year over year versus the overall used car market growing at only 7% year over year. Now, the interesting thing going into this earnings report for Vroom is that the company has already pre-announced intra-quarter. They gave us the color already as to how the quarter is shaping up. So there should be no negative surprises coming in here, which gives me some comfort, particularly having the technical price action already down in the basing formation. The company in early September mentioned that for the third quarter, they expect unit sales expected to be about 8,800 units versus prior estimate of 8,600 units. They also expect average selling price to increase to 24,500 versus prior guidance of 23,500. They expect gross profit per unit or per vehicle that they sell to rise to 1,900 versus prior guidance of 1,650. That GPU or gross profit per unit is the most interesting part that catches my attention, because a guidance that was previously provided as 1650 and now expected to be 1900, that's 15 to 20% above, and it's telling you that the total profitability metrics for the company have drastically improved, partly due to perhaps Manheim index has been very, very strong, and partly because of how COVID disruption has caused the online sales to take off, and as a result, with the economies of a scale, the average profitability per unit vehicle, those metrics have improved dramatically. Management also noted that their inbound logistics costs remain high. likely around $200 higher per car currently versus normal. So that is a little bit negative. That's going against the gross profitability. But I think the market will see that as a below the line item because the logistics cost overall should also gradually continue to come down. We saw that with Carvana also up until a year ago, where initially their logistic cost was too high as they were building out the platform and entering into new markets, but then gradually that came down, and as a result, Carvana stock just continued to materially outperform. And then lastly, in early September, Vroom also pointed out that they see that they're saying the automated pricing tool that the company has built along with the appraisals all done now at online, coupled with continued refinement of defect disclosure and reconditioning standards. All of these little tidbits of information continue to improve the quality of the platform. So these things are very positive, and the company has already set guidance. So we got the fundamental view that makes a lot of sense. We got the long-term bull case for the fundamental outlook of the industry as a whole with market penetration quite low. We got the option activity that was starting to pick up last week for a technical turnaround in the stock, and with earnings coming up. So there's a lot of things that are in locksteps over here. The only thing that is now waiting is for a potential technical breakout, and $52 is the key level of resistance in my book. So once we take that out, 52, then I could see easily a 10 to 15% gain in short term in Vroom. So keep an eye on this, and for now, just set the alerts on your screen. And so that's all I wanted to cover today. That's it from me. Jay.
Good morning, Pod. Today I want to highlight Vail Resorts, ticker MTN. So first off, technically speaking, looking at stock charts, a better entry for this stock would be if it pulled back to around the 220 level, which would coincide with trendline support.
Yeah.
So that's just a very quick overview of that. Now, fundamentally, in first read today, we covered the fact that Barclays is raising their price target to 254. One of the comments that they make is that the company's presence in the Northeast has been an important offset to other destinations during COVID-19. Well, there have been two notes within the last week that have caught my attention that really focus on Colorado as well as the Pacific Northwest. So KeyBank on October 14th hosted a call with meteorologist Joel Gratz of OpenSnow.com to discuss the snowfall outlook for the resort season. And this was largely optimistic. According to him, the most conviction he has lies in the view that there will be an above average season for both the Pacific Northwest and Whistler, as the region, according to him, historically performs well during La Nina years. And this also represents a notable improvement based on last season's unfavorable conditions. And along with this weather forecast, KeyBank noted pent-up demand for this season ahead, providing evidence such as higher equipment sales and commentary from consumers who are still looking and seeking, these safe outdoor activities during COVID. And then on October 19th, Truist was out with essentially a preview of the upcoming ski season, where they observed significant RevPAR outperformance in the month of September for hotels at Colorado ski resorts versus RevPAR for the rest of the country and for US resorts in general. Now, more specifically, Colorado ski resort hotel RevPAR was up 6.3% in the month of September versus minus 13.1% in August. And by comparison, overall US RevPAR was down 48.4% in the month of September, while overall US resort RevPAR was down 47.3% for the month. So net, they view these latest results, especially for the Colorado ski resorts, as a positive read-through for Vail.
Interesting that Colorado ski resorts year-over-year change in ADR terms actually is now already at pre-COVID level. So quite a V-shaped recovery there. People want to go out, and ski resorts becomes one of those, I guess, sporting activities where you're not packing in, I guess, as many people in one single spot, and so that is pretty much precisely what has started a similar kind of a strong bull trend and recovery in many other types of recreational activities, and so ski could be one of that. These charts are basically confirming a very powerful return back to the normalcy, essentially in pre-COVID level. So I would expect that at this point now, when they have reached those pre-COVID levels, that the overall trend will possibly decelerate a little bit from here. But I think it's very, very interesting to see how quickly this recovery has been. And naturally, the stock has also gradually returned back to pre-COVID levels. And purely technically speaking, I agree. If once it comes to 220, it provides a very low risk entry, because you can see there's all of this congestion around 215 to 220 level. Lots and lots of attachment over here, big VOP level over here. Really nice entry for a next leg higher, and just play it as a swing long entry using 3-month out calls or call spread, and that would be the way I would trade this. You agree?
I do agree.
All right, perfect. Great stuff, and very nice channel checks and the commentaries on this one. Chronicle.
Morning, Fahad. I was going to bring up Vail Resorts too, but Jay's already covered all the bases there. But apart from that, the other thing is to keep an eye out for a new Chinese Tech Demystified episode that'll go out shortly. It's already been recorded. And then next week, we're aiming to have an idea out for Jaguar investing.
Yeah, just to remind everybody that there is a video that will be going out today on a stock for a Chinese stock for the 6th episode of the Chinese Tech Demystified. We compiled this yesterday, edited and everything, so I'll be issuing that later this morning or early afternoon, so be on the lookout for that. Very interesting company, and it has pulled back and is providing a pretty interesting opportunity, so watch out for that video. All right, folks, short and sweet this morning. We'll see you in the chat room shortly. Thank you.